Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, January 10th, 2023. Welcome back to the podcast, George.
Great to be back, and Happy New Year, John.
Yeah, Happy New Year to you as well. George, I guess, looking back, as hard as 2022 was on markets, investors, you and me, it was a major, macro year full of all sorts of events that led to vol in the markets, many of which it was sort of anticipated, a lot of which totally wasn't. So in that sense, even though it was a challenging year, it was also a very rich year in terms of, and a good year from that perspective in terms of macro themes. With that said, and as background for our listeners, in this episode, we're going to focus on George's 2023 Macro2Markets Outlook entitled Passing the Baton, a shift from inflation to growth concerns. We'll also touch on recent events, associated with that. So, George, to get right into it here. So, as a first question, I don't want to dwell too much on the past, and looking backwards, but let's also set the stage. So given that 2022 was such a key year, why don't you provide a quick recap of how it changed your thinking and how it sets us up for 2023?
No, absolutely, and I think our former podcasts all throughout 2022 are a great reference point in the future to get a sense of how things evolved, because we did the play-by-play, and it felt like every week, as we mentioned, was like a month or a year. And we never ever want to bid away our time, and so I don't want to say good riddance to 2022. It was definitely, as you mentioned, a macro-rich environment. But let bygones be bygones. Let's just move forward here. But understanding like what took place in 2022 is going to be important for 2023. Look, we went from a world where market was initially skeptical that central banks were going to tighten as aggressively as they ultimately did. The Fed hiked 425 basis points over the course of 7 meetings, with many of those hikes being supersized 75s and 50 basis point moves, as well as put in place quantitative tightening. Meanwhile, we had very little fiscal support. We had a rolling set of bear markets through different parts of the equity complex. Initially had a pretty big widening in spreads, both in high yield and IG, which then kind of settled back down towards the bottom of the ranges. And all along through that, investors were faced with, especially the bond market for the first time, which really hurt the 60-40 bond portfolio, stock portfolio, bond portfolio, which was championed for so many years as a diversifying way to set up your investments. That 60-40 portfolio got hurt largely because the bond hedge didn't work. We actually had the worst total returns in recent history, if not going back many decades, if not a century, for overall losses in the rates markets, credits markets. So epic in so many different ways, but it does set the stage for 2023. And so while that was all happening, we had a first half of the year which was technically a recession, but of course the health and the strength of the labor market refutes that idea. But we had negative growth for a number of quarters. We had weak growth in general over the course of 2022. And to us, as we kind of outline in our 2023 outlook, the review part, it was a classic boom bust cycle. Too much easy money in the post-pandemic, and then through the early part of the recovery led to a massive inflation impulse, which is what led to the central banks being as aggressive as they were.
I mean, that was a pretty good recap of a crazy year in about 2 minutes. So well done, George. But let's dig into the more interesting or impactful part of the podcast. Your 2023 outlook. Let's specifically your piece was sort of organized around some major themes, some major calls on markets and asset classes and that sort of thing. But let's start with the U.S. economy. Where do you see it heading over the short term and the medium term? Let's say first half versus second half. Obviously, there's it's at least to some degree consensus the U.S. economy will fall into recession. Curious where you come out on that, et cetera.
Sure. I mean, I'd be remiss to say that we were one of the early adapters of this recession call. I mean, we had a 60% probability earlier in 2022, and then we upped it again to 75%. So it's really now a super strong base case that we think that we're heading into a meaningful slowdown. And the question for us really is how long, how deep, and what does it do for the overall economic environment? Like, will it be a situation where it's a kind of cleaning up and purging of malinvestments, which then sets up for a stronger recovery in the second half of the year or 2024? Or does it drag on, and instead of getting a proper recession and kind of like a flush, we instead kind of drag this out and we have like a stagnation, stagflation kind of debate? And if that were to take place, that's probably even worse in my opinion. So I still think the base case is a material slowdown. It might not be dubbed a recession right away, but I do think that that's coming. I mean, the flip side is that there is a chance that either by luck and by chance we see the Fed actually manage to get a soft landing, that other forces at play, maybe the China reopening, global provide some sort of bolster to global growth, which is also weakening. But that to me seems like wishful thinking. And this idea that we're going to look through and then we're going to have a soft landing is what the markets really desperately want, but I don't think that's what they're going to get. So for us, I mean, many of the high frequency indicators that we track are all now kind of pointing towards this is a recession. Fed models that predict recessions, the ISMs, both for the non-manufacturing, which is the service sector, had a pretty bad print most recently. Now, moving from fear of economic uncertainty to a proper contraction on the service side, which is nearly 70% of the economy. Manufacturing has been performing poorly, and all the real-time indicators there have been declining in a pretty fast way too. And so like every LEI indicators, all these high frequency forward-looking indicators are all signaling that we're going to have a recession. The big surprise for 2023 would be that all of these metrics that we've been trained on, both as economists and strategists over the last 20, 30, 40 years, like if they all fail us today, the yield curve being inverted, like that would be the big shock for 2023, that we have proof positive that all these signals are saying that something materially is going wrong in the U.S. economy, and it's about to really hit a hard patch here. I just don't see that would be the big surprise, I think, in my view. So I think that we're heading there, and really what we're going to try to determine is like how long, how deep, and how is it shallow recession, deep recession, is it fast, is it a drawn out recession? That to me is more important, because if that's going to play a big role for both investor psyche, because investors are acting as if this is going to be easy, we're going to get through it, it's going to be quick, and the Fed's going to react. But if we have high inflation and the Fed doesn't react, there's all these other variables now at play that makes it even more challenging for the outlook. But nonetheless, I think that's like the view for the very near term. And then in the second half of the year, hopefully we get through this more turbulent period and we're better off for it, and we'll end up seeing ultimately the Fed will react to it, but we can't necessarily price that in on day one, as we markets are trying to do, and they've been doing all throughout Q4. And that would set up for a better environment into 24 and into 25.
Yeah, it's interesting that you end with that. I mean, you and I have had conversations on the desk about this, but the market is really early in terms of pricing the peak in the Fed funds rate. They're pricing the Fed to cut rates in Q3, Q4 of this year, and they very well might be right, but it's a pretty bold call pretty early. So it'll be interesting to see if that's how that plays out. On the Fed though, I think you mentioned them in your previous response, but I think we should go into a little bit more detail on them and on the ongoing tightening cycle. As you mentioned, they hiked rates an incredible 425 basis points over the course of the past year. Other central banks are tightening. The central bank in Japan, totally shocked investors by widening the bands of yield curve control. Why don't you compare and contrast what's going on here domestically in the U.S. with what's going on globally? And, you've made a number of good points, and I don't want to steal your thunder. In your piece, you talk about how birds of a feather flock together, which I think is super critical. So again, I'll let you explain it for our listeners.
Sure, absolutely. So let's break down this question into two parts. Like basically, there is a Fed really kicked it off. ECB now is joining. Bank of England also, Bank of Canada have also been pretty aggressive. And now we have this news out of Japan, which could develop into a further story over the course of this year. And that's something that we plan on covering. And I know you and I both have a place in our kind of macro thesis that is really critical to us in our franchise. But let's just focus on the two pieces: the Fed and then other central banks. For the Fed, I mean, they're been pretty vocal, been pretty hawkish. Most of them, the Fed speakers, they want to get rates up to at least 5%. And I think they can hit that level, maybe even higher if it's justified. But we do think the Fed probably likely pauses somewhere around 5%. I mean, our base case, just for the record, is two more hikes of 25, but we do have a probability of a third hike at either the May or June meeting, depending on the developments in the labor market. But nonetheless, you kind of get close to 5%. And then the question is, like, how long does the Fed stay on hold? Historically, it's been about 2 quarters, max 3 quarters, that can get us well into the second half of the year. Even the Fed's forecast themselves for 2024 do project 100 bips lower. So it's not as if it's something completely out of scope that the market sees. Like the Fed dots are at 5 1/8, and then they have 4 1/8 for the following year. But the Fed doesn't want to commit to an easing cycle when they're still in the midst of tightening. So we have that to contend with. But our view quickly shifts in the medium to long term, which is more the second half into 2024, where our view goes from being we're not going to fight the Fed. We know in these environments, if they're hawkish, you have to respect that and you go along with that, which means that current pricing is mispriced both further out the curve in both short-term interest rates as well as on the Treasury curve. But at least the market, again, like this whole thing where they might end up being ultimately right just too soon. Largely because I think that the central banks are becoming much more dynamic and more proactive. So the Fed, again, gets rates up, stays there as long as they can. Meanwhile, we have these other central banks around the world that are also still tightening. And the big one really is, what does Bank of Japan do with its yield curve control policy? Does it, abandon it? Does it, do further tweaks? And what happens to overall QE out of Japan, which will have a big role in overall global rates and term premium, which have been suppressed for nearly a decade after BoJ initially launched QQE in 2013, and then in 2016 they launched yield curve control. So if we're really seeing the undoing of that part of QE as well as ECB doing QT along with the Fed, I mean, this is a lot of major changes in the central bank world and liquidity dynamics around the bond market, which should result in a higher term premium being commanded by the bond market investors to underwrite all this debt that was once being purchased by central banks. Like in theory, that's how it all should work out. The tricky part is, while this is all happening, if we truly do fall into a recession, bonds typically perform in a recession. I still believe that they would have that sort of economic hedge properties to them. And so maybe we don't get as strong of a bond rally because now the private sector has to underwrite these debt, not just the central banks. So I think that's what we're up against. My probability of a hike at the next meeting is high. I mean, they're going to hike in February 1st. The question is between 25 and 50, but given how the data is getting softer, and we'll see what CPI and inflation data brings us over the course of the month. But I think they're definitely going to hike in February. They're going to hike again in March, most likely. At that point, 25 basis points, I think. And then the question is, do they signal that they're almost done, or there's more to it, and then that will leave optionality for the May and June meeting, and we'll see what the labor market's doing at that point.
Okay, so another couple hikes or maybe more, getting us close to 5%. Sounds like mid-year, but watch out to see how things develop. Kind of up to that point, and then also keep an eye on other central banks and see what they do. As we all know, and as you pointed out, this is all very interrelated. So it sounds like the second part of this year will be pretty darn interesting. So let's move on. What I guess the maybe to sum all things up, you referenced this a little bit in your last answer. What do all these changes in the backdrop for global liquidity, as well as the onset of a potential U.S. recession, at the very least, low growth, mean for broader markets like rates, the curve, spread product, as well as equities and other risky assets in 2023?
Yeah, let's start off with rates, and we'll go down the risk spectrum. I do think that the fact that we still have again uncertainty about how many more hikes remain means that we should see higher rates across the curve, not just in the front end. The curve will still maintain an inverted posture, but I just don't think it'll be just super unusual that the Fed hikes another 75 basis points, potentially maybe more. We'll see, but 50 to 75 more, and the 10-year doesn't move. It should move. So I still think that matters. And then you have on top of that the beginning of the year, which we're seeing some elements of it, more corporate issuance, more Euro govy issuance. Again, ECB is doing QT. We'll see what happens with the developments around Bank of Japan's policies, which could easily be worth 50 basis points higher in U.S. rates if there's a preference to see Japanese capital staying home versus buying U.S. Treasuries. So, all that together means I still think there's one last kind of global rate sell-off, which will drag up long-term rates as well. It might end up being a great buying opportunity, but let's get there first before we kind of make that decision. And that at some point can result in mini bear steepening, as we're seeing that already starting at the beginning of the year. I think we'll see more and more episodes of bear steepening as positionings get realigned and things change in anticipation of a steeper curve later down the road. So that's the rates market. While that's all happening, I think vols probably still come down and compress, especially in the upper left, because I think you're going to see, and just overall short-term interest rates should stop moving as much because the Fed is no longer hiking, and most of the developments will be intermediate part of the rates vol complex. That should still help high quality spread products like agency MBS. So we do think that mortgages are after having a really difficult year in 2022, mortgages do offer value. They like every other asset class. I don't think that they're worth chasing early on, but combination of the higher rate environment, wider spreads, and we'll have episodes of that in the first half of the year. I think will be a great opportunity to kind of dollar cost average into agency MBS, and then the further down into the credit world, both IG and high yield. IG is not necessarily the focal point of concern when we think about credit. I think I'm much more worried about high yield and leverage loans and private credit in general. But IG, I think, still being the bigger markets within the credit complex, if there is weakness in credit broadly, you sell what you have to sell when you need liquidity. And I think IG can still witness higher and wider spreads, I should say, over the course of the year. So we have a range of about 115 to 175 in the cash index. And there's a risk for a move towards 200 basis points if we get into a more stressed environment on the macro front, which would eventually mean that there's not just credit hedging concerns, but also delinquencies and potentially credit defaults down the line, maybe not in IG, but in other products, which brings us really to high yield. And the high yield has been interesting, really diverging. There's been a lot of different reasons for it, which we're not going to have to time to cover it here. Fundamentally, the product is in a much better shape than it was in the last two crises that we've gone through, both in '08 as well as COVID. Funding's in a much better situation. However, it is the less liquid part of the credit complex, and it's also closely tied to the smaller caps and a lot of the zombie type companies that are very interest rate sensitive. And the Fed again has driven rates close to 5% and is looking to go there. So we're going to have a competition for capital within the credit space, and I think it's going to come to a head with wider credit spreads, especially in high yield, which I don't think we've seen the wides yet. So I think that all then means that equities themselves have one at least or two major declines still ahead of them before they present value in our view.
Okay, so to summarize, we higher rates in the front of the curve should catalyze higher rates out the curve, even if the curve remains inverted. Ultimately, that's a probably a buying opportunity and could catalyze some bear steepening. Vol comes down as the Fed, quits, moving rates by 75 basis points a pop and moves them by 25 or maybe even nothing at the second half of the year. High quality spread products, dollar cost average into it. IG, in pretty good shape, but it sounds like you're expecting some modest widening there, and you're much more concerned with high yield. Although interesting that you point out that it's really in better shape than it was the last two cycles, and sounds like maybe things get a little bit worse for stocks before they get better. Does that sound about right, George?
Good summary.
Okay, cool. All right. Well, hey, and heck of a summary on your part. That's a lot to fit in 15 minutes or whatever that was. And George, I really appreciate the effort you and your other analysts based in the U.S. here put in the piece, pulling together that annual outlook. And again, for our listeners, I would encourage you to check out George's 2023 Macro2Markets Outlook, Passing the Baton, a shift from inflation to growth concerns. And if you still are not receiving George's strategy reports, please do get in contact with him directly. Great stuff as always, George. Thanks again.
My pleasure, John. Thanks for being a great partner and interview over the course of the year. Appreciate it.
Yeah, it was 2022 was a heck of a year. 2023
can be better.
Yeah. Yeah, we could use it to be a little less exciting, but I'll take what we get. So, and thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.